Have you thought about becoming financially free through real estate investing, but don't have the time or knowledge to get started? Welcome to the Real Estate Cowboys podcast. Each week, we discuss passive income investment opportunities in the red-hot Texas market. John Larson and the Real Estate Cowboys will show you how to leverage their team to build wealth in real estate through passive investment opportunities. And now, here's John.
And welcome back to another edition of the Real Estate Cowboys. This is your host, John Larson. I just got back from an awesome investor tour trip down to Placentia, Belize. I was there from Thursday to Monday. Got some great weather, had about 12 investors with us. It was myself and Keith Weinhold from Get Rich Education. We hosted the tour. We showed our investors that came on the tour all the great opportunities that we see down there in Placentia, Belize. As we're starting to see rising prices in the American market, prices are back here at an all-time high, basically back to where they were before the last recession. Many investors are finding it very difficult to find rental properties that are spinning off, an attractive cap rate, especially when you're trying to target good neighborhoods to where you can really get that passive experience. And so a lot of our investors have been looking to invest outside of the U.S. and diversify into other countries where there's more affordable real estate that can still provide the same type of goals that they're looking for, but then also provide an aspect of lifestyle investing. And that is what we've really found in Placentia, Belize, is an opportunity to get in on a fast developing country, a country that has been growing by nearly 2% year over year. Tourism has been increasing year over year, and you see more and more major commercial airlines flying into Belize City. And so that's really an awesome sign. And Placentia is also on a very, very high growth pattern as well, to the point where they're now discussing putting in an actual hospital there. And they've already started the groundwork for an international airport and runway to be put into northern Placentia there, to where commercial airliners can start flying into Placentia. But they need that hospital there first. And once that's done, I definitely believe that the development of the airstrip and the terminal will be finished, and you'll start to see some major carriers starting to bring tourism and tourists directly into Placentia, Belize. And when that happens, I definitely would imagine that the real estate values in Placentia will skyrocket, especially the beachfront real estate. But for right now, it's affordable. It's affordable for the everyday investor to go down and buy a beachfront property or own a beachfront property with a group of other investors on a fractional ownership model or a private island, as we've been featured on HGTV with our partner David Keener. So there's a ton of opportunity, in my opinion, in the Belize market, especially for those of you that are looking for higher cap rates, more affordable property, and also looking for a bit of lifestyle investing as well. Someone who would like to enjoy their property when they want, and when they don't want to be in Belize, they can rent the property out and generate some cash flow from a vacation rental. And so Placentia, Belize really has some great opportunities in my mind. English speaking, dollar locked in 2-to-1, affordable real estate, chance to get in on an opportunity early. Like I said before, we believe that we have the same opportunity in southern Belize right now that you could have had in Hawaii in 1950. But enough about that. Let's move into this week's topic. And basically, just by being in Belize and understanding where a lot of my investors who were on the trip, I had investors from California, one from Colorado, one from Toronto. They're having some issues with finding good investment opportunities in those markets. The prices have just skyrocketed over the past decade. And it's getting to a point where, like I said, it's becoming tougher and tougher to find good single family and even multifamily opportunities in some of these large metropolitan areas in the U.S. And we're even running into the same issue here in DFW. Now, DFW is not on this list that I'm going to be going through here shortly. But this was a list that was compiled by 24/7 Wall Street, and it's a list of 21 cities that they deemed in America that they deemed overpriced, and they're areas where Americans are struggling to afford their homes. And for me, that's a scary thing, because I do feel like these are the cities that are going to take a hard hit and see some price decreases in value during this looming recession that all the economists are speaking of. And some economists are saying it could be as early as 18 months. Some are saying maybe we have another 24 months. No one can really tell. But, if there's already issues with people being able to afford their homes in these markets, and the prices continue to go the way that they're going, I just can't see them going much further if people in these major cities are already having issues affording the properties as is. And so, we even saw an article here from CNBC where they were saying that the real estate market is really slowed down in Southern California, and they believe it's because there's just no affordable housing available. And so it's really, really slowed down that market, and you could see why. So there's some other areas outside of California in the U.S. where they're experiencing the same issues. The government, as well as lenders, generally like to advise Americans to spend no more than 30% of their monthly income on housing. Still, 32% of American households are cost burdened. So according to the State of the Nation's Housing in 2018, a report compiled by the Joint Center for Housing Studies of Harvard University, they have found out that there is a serious shortage of affordable housing in the United States. Nationwide, the median rent has climbed 20% faster than inflation from 1990 to 2016, and the median home price climbed 41% faster over the same period. So we believe there's a lot of things that are playing into this. One, the last recession, there was no new development. They were not developing new land, so it's created housing shortages in many of these major U.S. cities, even here in DFW, which has caused the pricing to go up. But also there's a large influx of new people moving into the Dallas-Fort Worth market, but also there's a large influx of population growing year over year in the Dallas-Fort Worth market due to the job growth. Almost 150,000 people a year are moving into this market for jobs. And so Texas was just recently voted by CNBC as the #1 state in America for job growth. So that's huge, right? And I believe everything, there is all the hype about Texas. That's why I moved here. That's why I live here. And it's the first time that Texas has claimed top honors since 2012. So, and they base this on a few different things. And so the way that they rank the states is based on workforce, infrastructure, cost of doing business, economy, quality of life, technology and innovation, education, business friendliness, access to capital, and cost of living. And so the state of Texas ranked #1 in infrastructure and #1 in economy. And that is another thing that Texas has done well, I believe, is they have planned and performed on producing the correct infrastructure in these major cities to be able to add on almost 150,000 new residents in DFW, Houston, Austin, and San Antonio. These are all cities that are growing very quickly. And so, Dallas added, we talk about Dallas a lot, over 700,000 jobs since 2010. And 350,000 jobs were added into the state of Texas since last year. And a lot of that has to do with the fact that oil and gas prices are back on the rise. And so a lot of jobs from the energy sector are being added to the Texas market. And we all know when oil and gas is doing well, Texas is doing very well. And I believe that's why they claim the top spot this year. But some cities in America where I'm a little worried about them holding their value through a looming recession, number 21 on the list here would be Chicago. And Chicago is already a city where you're going to have a tough time finding good rental opportunities. And that's mainly because of the fact that the areas in Chicago where you're going to be able to enter some good middle-class neighborhoods, the values are not affordable. And the cap rates just are not there. And so if you're going to invest in Chicago and try and make the numbers make sense, you're going to end up putting your money in some more risky investments, some C and D class investments, which if you listen to last week's episode, why I stopped buying C class investments, you'll find out why I do not think that those options are really good investments, especially for the passive real estate investor. And that's what we're all about here at the Real Estate Cowboys, is passive real estate investing. You just don't find that passive model with a C and D class asset. And you're definitely not going to find a passive model in some of these areas of Chicago that might make sense for the numbers, but you're not buying a spreadsheet, you're buying a home. And you need to keep that in mind. So I was not surprised to see Chicago make that list at number 21. What they're seeing in Chicago is 17.6% of the area households are moderately burdened, spending between 30% and 50% of their income on housing, and 17.5% of the area households are severely burdened, spending over half of their income on housing. That to me is telling me that the market is already not affordable, and when we go through a down economic time, there's going to be some price decrease. The market has to correct itself. And so unlike most cities on our list today, housing costs as a proportion of income are rising at a slower rate in Chicago than across the nation as a whole, as is the median home price. The metro area's population grew by 0.1% from 2011 to 2016, even as the U.S. population grew by 3.7%. So that's another thing. Not as many people are moving to Chicago. You're seeing people actually leaving Chicago for other growing markets growing cities across America. And I think part of that reason is because of the fact that the good areas to live in the Chicago area are just not affordable any longer. Number 20 on the list is Boston. And the Boston-Cambridge area, Boston-Cambridge-Newton metro is one of the wealthiest in the United States. The typical household there earns just over $80,000 a year, far more than the national median of $57,000. It is also one of the most expensive places to live. A typical single-family home is valued at almost $450,000. And so that's the 7th highest median home value of the 100 largest metros in the country. And higher housing cost burdens in the city are driven by very low supply and relative to demand, particularly among the city's low-income tenants. So not a lot of low-income options in the city of Boston. And we all know, those listening to this show, Boston's just not a good market for single-family rentals and building a rental portfolio, because if you're looking for affordable rentals, the median value in this area is almost $450,000. And one of my general rules of thumb is you want to buy very close as you can to the median value in any market, because that's the way that you're going to really be able to mitigate your risk. And at $450,000 for the median home value, that just doesn't make sense. Number 19 on the list, Virginia Beach, Norfolk, and Newport News. Pretty affordable median home value at about $222,000. The median household income is only $60,000, so just slightly above the nation's average. And nearly 16% of the area households are severely burdened, spending more than half of their income on housing. And they're also attributing that to a lack of affordable housing for the metro area's lower income residents. The people that live in Virginia Beach, in that $30,000 to $45,000 a year income bracket, are spending between 30 and 50% of their income on housing. So not a good sign there as well. New Orleans checked in at 18. Low median single family home value, below $200,000. It's at $171,000. But the median household income is only $48,700. So it's about almost $10,000 below the national average. So that's another city where it's a bit concerning. We're seeing rising prices all over the U.S., but that does not mean that we're seeing rising incomes all over the U.S. And so those are the areas of the U.S. that I'm really concerned about. Those are the areas that I feel like The values just cannot get any higher. And if they do, you're going to see a very strict market recorrection for sure. So you're going to see some values dropping just because of the mere fact that its population cannot afford the homes in the market, not at the rate that it's going. Number 17 on the list is New Haven, Connecticut. I can see why. There's not really any people moving there, not really any economic drivers. The housing value is pretty affordable. The median household income is pretty decent at almost $67,000 a year. But there's just not enough people moving into that market, and you're starting to see an uptick on supply due to that. Number 16, San Jose. Explosive economic growth in the tech sector, and that's led to the skyrocketing home prices. Typical single-family home in San Jose is now valued at $1.2 million. That's the highest median home value in the nation's 100 largest metro areas. So, once again, you have a median household income in that area of over $100,000, but a median single-family home value of $1.2 million. Very, very high. I know that there's jobs there. I know that tech jobs are booming in that area, but I just feel like at $1.2 million, it can't go any higher. If you're listening to this show, you own some investment properties in San Jose, I would think now would be a great time to sell. Take that equity, put it into some other assets, do a 1031 exchange, buy some other properties at some more affordable markets in America. Number 15, Stockton, California. You have a more affordable single-family home value, still close to $350,000, and the median household income is below $60,000, checks in at $59,000. So you're still having a lot of high demand in this market, but with a median household income below $60,000, it's really tough for the residents of Stockton to afford properties and a median home value of $350,000. Number 14, Sacramento, another city in California. Rapid population growth there is driving up housing demand and costs. The number of people living in the Sacramento metro area increased by 5.5% from 2011 to 2016, faster than the national population growth rate of, like we said, 3.7%. And over the same period, the typical monthly mortgage payment in the metro area increased by 92.5%, more than double the 41.4% increase nationwide. So that's very, very alarming in my opinion. All right, we're going to take a quick break. When we come back, we're going to finish out with the rest of the cities on this list. We still have 13 more to go. So we're going to take a quick commercial break. We'll be right back.
Did you know there are 6 different ways real estate pays investors? Are you interested in getting started with real estate investing but just don't know how? Investing in real estate can be challenging, especially if you don't have the time, experience, or resources to do so. At American Real Estate Investments, they do all the hard work for you. They're a DFW-based company that buys homes in great neighborhoods, professionally renovates them, and places business professional tenants in your property. With their program, you can start earning headache-free passive income and equity growth from appreciating values in the fast-growing DFW market. There is no better place in America to invest in real estate today. To learn more about how their investors are earning up to 100% returns or greater with their program, give them a call at 888-323-AREI or visit their website at areiusa.com. That's 888-323-AREI or areiusa.com.
And welcome back to the Real Estate Cowboys. It's your host, John Larson. We are discussing some markets in America that I believe are overinflated. There's cities in America where Americans are struggling to afford their homes. And it's concerning to me because I feel like we are in a situation here in America where, you know, the prices are back at an all-time high, and I don't know how much higher they can go. And so this is an episode that's basically designed for investors. If you own properties in these markets, or if you live in these markets, or if you're thinking about investing in some of these markets, you may want to think about selling right now. You may want to think about avoiding certain markets like this, because I just believe that the mere fact that the citizens of these cities, the population in these cities, are having a hard time affording the housing in these areas right now. And that tells me that a correction is coming, and we do see a possible recession here looming very quickly. And so I worry that these markets are going to take a pretty hard hit to the current value of the real estate in these areas, because of the fact that the residents of these areas are already having a tough time affording property. And we all know markets are cyclical, and I do believe there is a time for that the recorrection is coming. The time is very, very near. And so selling your property in California, 10 cities in California made this list, might be a good time. It might be a good time to sell that property, take advantage of the 1031 exchange, get that money working for you in other markets across America that make more sense. And, that is why I'm such a big proponent of Texas. It's growing rapidly. As I said earlier in the show, it added over 350,000 jobs this past year. Oil and gas is back. Things are booming. The market here has been booming for the past decade. The economy has been booming. You're seeing affordable real estate, solid median income. That keeps going up. The residents of Dallas-Fort Worth and Houston, they can afford their properties. Okay, it hasn't inflated to a point where it's just unaffordable. But there's 21 cities that we have that have been identified as the cities where Americans are struggling to afford their current property and property in that market. And so I feel like now is a good time to sell. And so 13 on the list is San Francisco. Not surprising. You're talking about a median single family home value that's almost $1 million. You do have a median household income that's almost $100,000, but the San Francisco area is one of the wealthiest in the country. And the typical household there earns $96,000 a year, nearly 40% more than the national average. It is also one of the least affordable places in the country. The typical single-family home costs nearly $1 million, second highest median home value in the nation's 100 largest metro areas. So I know a lot of people that live in San Francisco. They've been saying the same thing. I don't know how much higher the market can go. It's due for a recorrection. I definitely believe that. So San Francisco checked in on that list. Number 12, this is a city I've been hearing as a great city to invest in, tons of opportunity, good, decent cash flow market. This has been an area and a city that a lot of investors have had their attention on, but it checks in at number 12, Orlando. Median home value is pretty affordable at $217,000, but the median household income is only $52,000. It's below the national average. And so, although the city's population grew by 12% between 2011 and 2016, that's more than 3 times the national population growth. The increased demand for housing has contributed to a massive increase in home values, making the real estate less affordable for many of Orlando's lower income residents. A typical home in Orlando right now is worth 4.4 times the median income in the city. That's up 50% from 5 years ago. That's the 8th largest increase in price to income ratio of the 100 largest U.S. metro areas. So Orlando, yes, looks good. Some opportunities may look good on paper, but what we're seeing here, values are rising much faster than the median income of its residents, and it's becoming unaffordable. And so that is something that you need to look at if you're interested in investing in Orlando or already investing in Orlando. Might be a good time to sell, maybe, I don't know, but these are the type of markets that I am definitely fearful of. Most of them, they don't make sense for a cash flowing investment model anyway. Many cities in California that we've already named, but Orlando has always been one that's out there lately that's been popular, and I'm just putting it out there as a possible warning. The market could be just gaining too much steam. The values could be getting too high. It's outpacing what the median income is in the market. So that's usually a telltale sign that market could be, you could definitely see some values dropping during a recorrection. Number 11, Las Vegas. This is another one that's been a popular investment destination. You see more and more people trying to purchase single family homes for rentals or doing developments in the Las Vegas area. Once again, problem with Vegas, the median household income is only $55,000. The median single family home value is now at $250,000. The Las Vegas metro area reported one of the steepest housing price increases in 2017. The home prices rose 14% last year compared to 6.2% being the average nationwide. Over 50% of the residents there are either moderately or severely burdened by rent prices. Across Las Vegas, 37.6% of households pay more than they can afford on housing. So that was one thing that I always brought up about Vegas. I could understand, I guess, why investors were looking to invest in that market, but there's just not enough jobs. The economy is not good enough to support these rising prices. And so I think Vegas is definitely an area that you're going to see some serious market recorrections coming up soon. Number 10, another city in California, Bakersfield. In Bakersfield, you're going to see more affordable homes, slightly over the $200,000 mark, but the median household income is only $50,000. The home ownership rate there is below 60%. So a relatively large share of Bakersfield residents face serious financial hardship. Some 23% live below the poverty line, one of the highest poverty rates in any of the U.S. metros, and it's well above the 14% U.S. poverty rate. So Bakersfield is just one of those lower income areas of California, areas that I personally like to avoid when I'm investing in single family homes. Just not enough jobs, not enough good jobs, and you can tell there by the median household income only being at $50,000. Number 9, Bridgeport, Connecticut. Very solid median income. You're at about $90,000. It's a decently wealthy area. Average home value is about $325,000, and this is just one of the least affordable cities in the United States. Typical single-family home in Bridgeport is worth, like I said, about $325,000, and it comes with one of the higher median home values, out of the 100 largest metro areas. The issue, though, with Bridgeport is that housing is particularly unaffordable to the area's low-income residents, and so that's where it's a very maybe high-end area, not a good area for investment, though, because of the fact that, affordable real estate is just, it's not very readily available in this market. Number 8 is going to be urban Honolulu in Hawaii. As we know, I wouldn't be looking at Hawaii as a good investment opportunity right now, but median household income of almost $80,000, and home prices have risen far faster than incomes in Honolulu. San Jose and Los Angeles are the only U.S. metro areas with higher median home sales price to income ratios than Honolulu. San Jose has the highest median home value in America right now, and so that is a disconcerting stat. But obviously, Hawaii doesn't make sense for cash-producing properties anyway. Number 7 is Oxnard, Thousand Oaks, Ventura, California. You're going to have a median single-family home value of just over $575,000, and the median household income is only $78,000. And so this is one of the most expensive areas in the country. Typical area home worth almost $600K, and as a result of this, it's only one of 5 metro areas nationwide where most of the residents. And because of this, it is only one of 5 metro areas nationwide where most residents who finance their homes spend over $4,000 per month on mortgage payments. Number 6, Fresno, California. This is another affordable area of California. Median home value, $235,000, but the median household income is under $50,000. I can't understand how people can afford to live in some of these areas. And so the typical household in Fresno earns just $48,600 a year. That is $8,400 less than the U.S. median, and it's the 11th lowest median household income for the 100th largest U.S. metro areas. And so Fresno is currently in need of around 35,000 affordable housing units. And California requires that apartments be solar powered, and that has caused construction workers to be paid higher wages than they would receive on a private sector project, driving up construction costs considerably. That's another issue that California is having with affordability. Number 5 is Riverside, San Bernardino, California. Median single-family home value is $350,000, and the median household income is only $56,800. Once again, 3 of the 5 U.S. metro areas with the worst housing cost burden rates are in California. As of 2017, the area's median home price was 5.7 times the area's median household income. That's almost a 57% increase from 5 years earlier. That's insane. Number 4 on the list, obviously we all knew that this one was coming up. It's going to be New York and New Jersey. More than half spend over 50% of their income on housing. New York's homeless population is the largest in the country, and it's been climbing in 3 of the last 4 years to over 80,000 people. When you're talking about a median single-family home value of $420,000 and a median household income of $71,000. Number 3, San Diego, median home value of $570,000, median household income of $70,000. San Diego increased by almost 30% over the last 5 years. The price of a typical single-family home relative to income in San Diego increased by almost 30% over the last 5 years. Today, over 43% of the area's households spend at least 30% of their income on housing, and housing prices may continue to increase rapidly as the city runs out of developable land, being right there on the Pacific Ocean. Number 2 is Miami. No real surprise there. The median single-family home in Miami is $263,000, and the median household income is only $50,000. So with the typical household income being only $50,000, that's far less than the national average of $57,000. Some 46% of Miami households spend at least 30% of their income on housing, the largest of any major city other than Los Angeles. And renters in Miami are not spared. Adding amenities and rising construction costs have pushed average rents for newer units to over $2,000 in the city. That would bring it to over 60% of renters in the metro area are spending at least 30% of their income on housing. So we're going to take a quick commercial break, and when we come back, I think I kind of already gave it away, but we're going to reveal the number 1 city in America where Americans are struggling to afford their homes, and the number 1 city in America where I feel like we're going to be coming into a serious recorrection if and when that next recession is coming. So stay tuned. I'm going to reveal the number 1 city in America where Americans are struggling to afford their homes. Be right back.
Looking to complete a 1031 tax-deferred exchange and are needing financing for your replacement properties? Let Graham Parham at Highlands Residential Mortgage guide you through the process and make your 1031 exchange go smoothly and on time. As a seasoned investor, Graham owns several investment properties himself, and he can share with you the best way to plan your exchange. Graduate into a better property or properties and make use of leverage to obtain better cash flow and higher returns on investment. Highlands Residential Mortgage has one of the best in-house loan processes to deliver your loan on time and without any surprises. We are 1031 exchange friendly. Call Graham's toll-free direct number today at 855-326-6802 for your free mortgage consultation, or visit us online at texasinvestorloans.com. Highlands is an equal opportunity lender, NMLS 195724, located 1201 North Central Expressway, Dallas, Texas, 75234. Highlands Residential Mortgage, NMLS 134871, is not a financial advisor.
And welcome back to the Real Estate Cowboys. This is John Larson. We have come to the number 1 city in America that is definitely due for a market recorrection, in my opinion and many others' opinion, and that is Los Angeles, Long Beach, Anaheim, California. In Los Angeles, housing prices increased at a faster rate than income, leading to the city becoming unaffordable for a large share of residents. According to the Joint Center for Housing Studies at Harvard University, a household earning the median income in Los Angeles could afford monthly mortgage payments on just 11% of homes recently sold in the area. That's amazing. And so that just goes to show Los Angeles, it's just too high. Its residents cannot afford to live there. That is definitely a major factor in a market that is that's showing signs of a crash. And so there's 12 actual housing crash factors that you can look at in any market. And number one is going to be excessively high home prices via a price bubble. Increasing underwater mortgages, fast rising interest mortgage rates, slowing economy and sudden rises in unemployment, wage growth not keeping up with home prices, and that's mainly what I'm looking at on this list that we went through today. The wages are just not growing, the jobs are not there, the economy is not there to support the housing prices rising so rapidly. Tax changes and geopolitical shifts can be a factor. Trade deal disturbance, a stock market bubble, or stock market volatility, high level of consumer debt affecting debt services, cost of living rises, and we're seeing that in today's economy. Obviously, inflation each year, which looks like it's going at about 5%. The cost of living keeps increasing in many of the cities that we named on this list. The average median income, or the median income in that area, is below or well below the national average. And when you add in the fact that the real estate market is becoming unaffordable, that is just not a very good sign. Risky low rate mortgages for new home buyers. We have been seeing that the past few years, actually more than that since 2010. Very low rate mortgages for new home buyers, and high oil and gas and energy prices. And we're starting to see oil and gas creep up in this year in 2018. And so we also saw a little bit of a spike in mortgage interest rates. I've been doing a lot of research myself, and I have found that historically, when oil and gas prices and mortgage rates increase rapidly at the same time, it is definitely a sign that a recession is on its way. But I do believe we are probably 18 months, 24 months away from a market recorrection. And I definitely predict that a lot of these high-priced markets here are definitely going to be going through a correction. So, like I said, if you are investing in these cities, if you're living in these cities, it may be a good time to sell at when you can, sell when the market's at its highest. Definitely investments, because you could sell these investments and do a 1031 exchange and put the equity that you've earned in these investments into other markets, other more affordable markets across America that are not showing signs of a bubble or showing signs of the population not being able to afford the real estate in that market any longer. I definitely think it's the right time to do that. For people who are owning a home right now and probably saying, well, John, if I sell my home, what am I going to buy? And I'm with you. But if you're sitting on a lot of equity in your own personal residence, it may not be a bad idea to sell, take the equity, rent for a little bit, let the market correct itself, and then go and buy something when the market does take a dive, because it's definitely coming in these cities. And there was also some cities that didn't make the list that I wanted to mention. It's kind of an honorable mention, and those would be Seattle, Phoenix, Tampa, Nashville, Denver, and Portland. They did not make this list, but I also would be wary of some of these cities as well if you own property in any one of these cities. There's been a lot of things in the news that have been talking about. Seattle is coming towards a potential crash as well. And Phoenix, I just feel like does not have the jobs or to support the rising prices. You have a lot of retirees moving there. Tampa is sort of the same thing. So those are the things that you have to look for in some of these markets where you're just seeing overinflation, prices rising rapidly year over year, but they don't have the type of job diversity and diverse economy to support these rising prices. You also need to see wages growing year over year if the population in those cities are going to be able to continue to buy property in those cities across America. So there's definitely something that you need to look at. But that's it for this show. Thank you for tuning in. If you like the information that you heard today, or you want to listen to any other episodes of the Real Estate Cowboys, you can subscribe to us on iTunes. You can subscribe to us on pretty much any podcast outlet that's available. You can also go to our website, www.realestatecowboysdfw.com. There's a bunch of great information on that website. You can listen to past episodes. You can also subscribe to our list to start receiving free passive income investment options. You can get basically first look at all these great passive income investment options that are available through the Real Estate Cowboys. We have private lending opportunities that are very, very popular for our IRA and 401k crowd that has self-directed funds, or are interested in self-directing and doing private lending for high double-digit fixed rate returns that go back into the retirement account, tax-free or tax-deferred, depending on what type of account you have. And all those lending opportunities are in the state of Texas, where I believe, just things are booming. Like we said earlier, Texas added 350,000 jobs this past year. So I just feel that this is a great market to be a private lender and do developments here in DFW and Houston. While the market's still affordable, while wages are still growing, while jobs are being added, while people continue to move in at a very high rate, almost 150,000 people a year moving into DFW and Houston respectively. So great areas, in my opinion, to do developments. If you're a single family rental investor that's looking for passive income from rentals and also want to take advantage of leverage and cash in on a growing market and hopefully see continued equity growth year over year, we also have those opportunities. Or if you are looking for some possible vacation opportunities, maybe you're sitting there and saying, yeah, the market here in the U.S. is just too high, can't find good cap rates. There's also opportunities outside of the U.S. And one, like we discussed, that we really love is Belize, and Southern Belize specifically in Placencia. So if any of these options sound good, go to the realestatecowboysdfw.com, put in your information, join our mailing list. Also, we have a really cool quiz there. If you don't know what type of investor you are and you're interested in just getting started, you can take one of our quizzes, our investor quiz, and it'll tell you, based on the answers that you give us to our questions, what type of investment model is probably best for you. So you can go check that out on the Real Estate Cowboys DFW website as well. And be on the lookout for my book, The Passive Income Guide. It will be coming out soon. Very, very excited for this. We're going through the final revisions, and it will be available on Amazon very soon and available at our website, Real Estate Cowboys DFW. So thanks again for tuning in, and remember, what is your return on life? This is John Larson signing off.
All opinions expressed by the hosts of the show are the opinions of American Real Estate Investments, LLC, and do not reflect the opinions of guests or sponsors. No personal or professional advice heard on this program should be considered an endorsement to follow a real estate financing or investment strategy. Before acting on any information, seek advice from your financial, tax, mortgage, or real estate advisor, as the information is not guaranteed and investment strategies have the potential for profit or loss.